The S&P 500 just hit 6,976, all-time high. Gold surged past $5,500 an ounce, all-time high. The Fed cut rates 3 times in 2025, and unemployment just hit 4.4%, the highest level in more than 4 years. When stocks are soaring and people are losing jobs, when gold is screaming warnings and the Fed is cutting rates while claiming victory over inflation, when 7 companies control over 1/3 of the entire market and the government is borrowing $5 billion per day just to keep the lights on, something fundamental has broken. The question isn't whether the market will crash. The question is why it hasn't already, what's keeping this thing airborne, and how much time you actually have before the math stops working. My name is Alex, and I've spent the last 15 years tracking market cycles, Fed policy, and the kind of data that most people never see buried in INI reports and Congressional Budget Office filings. I obsess over this stuff so you don't have to. If you want to understand what's really happening in these markets and protect yourself from what comes next, make sure to hit that subscribe button and give this video a thumbs up if it helps you see through the noise. Before we dive in, I want to know, what's your silver price prediction by end of 2026? Drop it in the comments. I'm genuinely curious where this audience stands. Here's what I'm going to show you. The market didn't survive the last crash because the problems got fixed. It survived because the problems got papered over with the biggest monetary expansion in peacetime history. And that paper is starting to tear. What happened in April 2025 was a warning shot. What's happening right now, with all-time highs and rising unemployment happening simultaneously, is the market telling you 2 completely different stories at the same time. One of them is lying. Let's start with what actually happened in April 2025, because most people have already forgotten. April 3rd, 2025. The S&P 500 dropped 4.84% in a single day. The next day, April 4th, it dropped another 5.97%. 2 days, approximately $5 trillion in market value, gone. That was the worst 2-day percentage decline since 1950. Not since 2008. Not since 2000. Since 1950. We're talking about a 75-year record. And then something remarkable happened. The market fully recovered. By June 27, 2025, the S&P 500 was back at all-time highs. As of February 2026, it's trading around 6,976, like nothing ever happened. That's not normal. When you see a crash that severe recover that fast, it's not because the problems disappeared. It's because someone stepped in. And when you look at what the Federal Reserve did, when you look at what happened to the money supply, when you look at government spending during that exact window, the picture becomes very clear. The crash didn't end because confidence returned. The crash ended because liquidity returned. But here's the thing, that liquidity has a cost, and we're starting to see the bill come due. Goldman Sachs is projecting a 12% total return for the S&P 500 in 2026. Morgan Stanley has a year-end target of 7,500. January 2026 saw the S&P gain 1.4%, which historically signals an 84% chance of a positive full year. The forward PE ratio is sitting at 22.2, above the 5-year average of 20.0 and well above the 10-year average of 18.8. Earnings growth for Q1 2026 is projected at 11.7%, full year 14.3%. On paper, everything looks fine, better than fine, it looks great, except unemployment is at 4.4%, the highest it's been in more than 4 years. The labor market has been in what economists are calling a low-hire, low-fire mode since summer 2025. Economists expect unemployment to peak at 4.5% in early 2026, and there's a 1 in 3 chance of recession this year. So let me ask you this. When in history have stocks hit all-time highs while unemployment is rising and recession risk is climbing? I'll tell you when. Right before the crash. 2007, 1999, 1929. The pattern is always the same. The market peaks when the economy is already rolling over. Because the market doesn't price in what's happening now. It prices in what investors believe will happen 6 to 12 months from now. And right now, investors believe the Fed will save them. Again, the Federal Reserve cut interest rates 3 consecutive times in 2025. September, October, December. The current rate sits at 3.50 to 3.75%. At their January 2026 meeting, they held rates steady. And they're signaling only 1 additional cut expected for the entire year. Kevin Warsh, the new Fed chair nominee, is seen as more hawkish than his predecessor. Translation: the era of easy money is ending, or at least it's supposed to be ending. But here's where it gets complicated. Because even though the Fed is signaling fewer cuts, even though they're trying to project strength and control, the fiscal side of the government is doing the exact opposite. The federal deficit for fiscal year 2025 hit $1.8 trillion. The rolling 12-month deficit peaked at $2.0 trillion. For the first time in American history, interest payments on the national debt exceeded $1 trillion. The government is borrowing $5 billion per day just to pay its bills. The national debt is now over $37.6 trillion. Let that sink in for a second. The government is spending so much money that just the interest on the debt, not paying down the debt, just the interest, is over $1 trillion a year. That's more than the entire defense budget. Now we get to the part that actually matters. Everything before this was just context. What I'm about to show you next is the structural fragility that makes all of this unsustainable. The so-called Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. These 7 stocks now account for 34 to 35% of the S&P 500's total market capitalization. They contributed 54% of the index's price gains over the past year. They contributed 44% of the earnings growth. The top 10 stocks now represent 39% of the index. At the peak of the 2000 tech bubble, the top 10 were 27%. We are more concentrated now than we were at the height of the dot-com mania. This means that if you own an S&P 500 index fund, you think you're diversified. You think you own 500 companies. But in reality, your performance is almost entirely determined by what 7 companies do. And if those 7 companies stumble, the entire index stumbles. There's no safety net. There's no diversification. It's an illusion. And here's the kicker. The 493 stocks outside the Magnificent significantly underperformed last year. If you weren't in those 7 names, you didn't participate in the rally. The market didn't go up. 7 stocks went up and dragged the index with them. Let's talk about Nvidia specifically, because Nvidia is the poster child for everything that's both amazing and terrifying about this market. Nvidia's market cap is approximately $4.4 to $4.6 trillion. It is the most valuable company in the world. It was up 37% in 2025 alone. The Rubin architecture is launching in the second half of 2026, and Wall Street expects between $320 and $350 billion in data center revenue for the year. Nvidia is not a bubble in the traditional sense. The company has real earnings, real products, real demand. AI is not a fantasy, it's happening. But here's the problem. Nvidia's valuation assumes that nothing goes wrong. It assumes demand continues to accelerate. It assumes no competition emerges. It assumes the economy stays strong enough to support massive capital expenditures from every tech company on Earth. And it assumes that AI delivers the productivity gains and revenue growth that everyone is betting on. If any one of those assumptions breaks, Nvidia doesn't go down 10%. It goes down 50%. And when Nvidia goes down 50%, it takes the entire market with it. Because Nvidia alone represents a significant percentage of the index. That's not a market, that's a Jenga tower. Now, while all of this is happening, while stocks are hitting all-time highs and concentration risk is at historic extremes, there's something else happening that almost nobody is paying attention to: gold. Gold returned 67% in 2025, the best year in 45 years. On January 29, 2026, gold hit an all-time high of $5,555 per ounce. It's currently trading around $4,900 to $5,000 after a sharp pullback. JP Morgan forecasts an average price of $5,055 per ounce by Q4 2026. Over the past 12 months, gold is up 100%. Gold doesn't care about earnings growth. Gold doesn't care about innovation. Gold doesn't care about the next killer app. Gold does one thing. It reflects fear. Fear of currency debasement, fear of inflation, fear of fiscal irresponsibility, fear of geopolitical instability. When gold goes up 67% in a single year, it's not because investors are optimistic. It's because they're terrified. And they're moving money into the only asset that survived every currency collapse, every government default, every war, every financial crisis in human history. So you have stocks at all-time highs, and you have gold at all-time highs, both at the same time. That doesn't happen unless the market is deeply confused about what's coming next, or unless different groups of investors are betting on completely opposite outcomes. Let me show you why this is happening. And it comes down to one thing: money supply. The M2 money supply in January 2020 was $15.5 trillion. By December 2025, it was $22.4 trillion. That's a 45% increase in 5 years. $6.2 trillion created in just 2 years, 2020 to 2022. And here's the critical part. M2 growth started accelerating again in late 2025. When you create $6 trillion out of thin air, that money has to go somewhere. It went into stocks. It went into real estate. It went into crypto. It went into gold. It inflated the price of everything. And now the Fed is trying to slow that down. They're trying to tighten. But the government is still spending like there's no tomorrow. So you have the Fed pulling money out of the system with one hand, and the Treasury pumping money into the system with the other hand. The net effect is that liquidity is still positive, but it's slowing. And when liquidity slows, asset prices stop rising. And when asset prices stop rising, the everything bubble starts to crack. The real question isn't whether we're in a bubble. We are. The real question is what pops it. And I think the answer is already showing itself. Inflation is not gone. The CPI for December 2025 was 2.7% year over year. Core CPI, which strips out food and energy, was 2.6%. The Fed's preferred measure, the PCE, was at 2.8%. All of those numbers are still above the Fed's 2% target, and inflation is expected to remain elevated through 2026. So the Fed is stuck. If they cut rates too much, inflation reignites. If they don't cut rates enough, unemployment rises and the economy tips into recession. And if they try to thread the needle and do nothing, they risk both outcomes at the same time. Stagflation. We've been here before. The 1970s. Stocks fell 50% during that decade. It wasn't a crash. It was a slow bleed. High inflation, low growth, rising unemployment, and a market that went nowhere for 10 years. Or look at 2000. Everyone said the internet was the future. They were right. But that didn't stop the Nasdaq from crashing 80%, because valuations matter. And when valuations get detached from reality, the market eventually corrects, violently. Or 2008. The banking sector looked fine, right up until it didn't. Bear Stearns collapsed. Lehman collapsed. The entire financial system nearly collapsed. And it happened fast, faster than anyone expected. Even 2023. Silicon Valley Bank was a top 10 US bank. It collapsed in 48 hours. Nobody saw it coming. Or more accurately, the people who saw it coming were ignored. History doesn't repeat, but it rhymes. And right now, the rhyme scheme is getting louder. Here's what most people don't understand. The market doesn't collapse because things are bad. The market collapses because things are bad and everyone finally realizes it at the same time. Until that moment of collective realization, the market can stay irrational. It can stay elevated. It can keep climbing even as the foundation crumbles. But that moment always comes, and when it does, it happens fast. So what wins and what loses when this thing finally tips over? The winners are the people who position themselves correctly before the realization hit. Gold is up 67% in 2025. Silver had a similar run. Commodities broadly are performing. Certain real estate markets, the ones with actual supply-demand imbalances and population growth, are still holding value. And the right stocks, not the index, but specific companies with real earnings, real pricing power, and real moats, those will survive. The losers are the people holding cash because inflation erodes it. The people holding long-duration bonds because rising rates destroy them. The people holding diversified stock portfolios outside the Magnificent Seven because those 493 stocks have been going nowhere. And the people who think this time is different because it never is. The psychological trap here is normalcy bias. You look at the market, it's at all-time highs. You look at your portfolio, it's up. Everything feels fine. Your brain tells you that because things have been fine, they will continue to be fine. That's not logic, that's emotion. And emotion is what gets you hurt in markets. The smart money isn't asking whether the market will crash. The smart money is asking what they're going to do when it does. They're asking what percentage of their portfolio is in assets that go up when everything else goes down. They're asking whether they're positioned for deflation or inflation, because one of those is coming and nobody knows which. They're asking whether their time horizon is 5 years or 5 months, because that changes everything. Now let me tie all of this together, because when you see how these pieces connect, the picture becomes very clear. You have a market trading at all-time highs driven almost entirely by 7 stocks. You have unemployment rising and recession risk climbing. You have a government borrowing $5 billion a day with no plan to stop. You have a Fed that's trapped between inflation and recession. You have the money supply expanding again after a brief contraction. You have gold hitting all-time highs, which is the market's way of screaming that something is wrong with the currency. And you have historical patterns: 1970s, stagflation, 2000 dot-com, 2008 financial crisis, that all say the same thing. When valuations get this stretched and the economy starts to roll over, the market doesn't stay elevated, it corrects. The April 2025 crash was a warning. The recovery wasn't a sign that everything is fine. It was a sign that liquidity is still propping this thing up. But liquidity is finite. And when it runs out, when the Fed can't cut anymore, when the government can't borrow anymore, when investors finally look around and realize that 7 stocks can't carry an entire economy, that's when the real move happens. The market hasn't collapsed yet because the belief is still there. The belief that the Fed will step in, the belief that earnings will keep growing, the belief that AI will justify every valuation, the belief that this time is different. But belief is not a strategy, and hope is not a plan. What I need you to understand is that the time to prepare is not after the crash, it's before. And right now, you still have time. Not a lot, but some. The market is giving you signals. Gold at all-time highs is a signal. Rising unemployment while stocks rally is a signal. Concentration risk at dot-com levels is a signal. A $2 trillion deficit is a signal. These aren't secrets, they're right in front of you. The question is whether you're paying attention. So here's what you do. You look at your portfolio. You ask yourself, if the market drops 30% tomorrow, how does this perform? If inflation goes to 5%, how does this perform? If we get a recession, how does this perform? And if the answer to any of those questions is badly, you adjust. Not all at once, not in a panic, but deliberately. You don't have to predict the future, you just have to be prepared for multiple futures. That's the difference between surviving the next downturn and getting wiped out by it. Your future self, the one looking back at this moment 5 years from now, is either going to thank you for paying attention or curse you for ignoring the signals. That version of you is counting on the decisions you make right now. Before I wrap up, I want to know, what financial topic is affecting your life right now that you can't find a straight answer on? Tell me in the comments. That's what this channel is for. The market will do what it always does. It will climb until it can't, and then it will fall until it finds a floor. The question isn't whether that happens. The question is whether you're ready when it does. Stop chasing the all-time highs. Start building the foundation that survives what comes next.